Hello and welcome to our first one of these presentations for the year. So this is going to be our first investment update with 24/7 Investment Management, our discretionary fund manager. And with me today, I've got William McBride, who is our he's the Chief Investment Officer of that company. And he's going to sort of give us an update on what's happened. So welcome, Will.
Yeah, hi, you okay?
So let's start off with, it's been a bit of a turbulent period over the last 3 to 4 months. And the last one of these we did was in November. Do you want to sort of just run us through what's happened within the portfolios over that period?
Yeah, sure. Obviously, autumn time is a very prominent time with the US election, with Trump getting into power, and obviously the budget in the UK. So markets were very sort of volatile. UK had an initial spike up and then pull back. US had a really big, move forward in their markets. But obviously since then, we've seen a material pullback. What we did in October time, we actually took some profits off the US market exposure. So we thought we had a really good 2024 to date. It was obviously we weren't sure if Trump was going to get into power. So there's uncertainty there. Again, as we're seeing now, the negativity coming through with the trade and the tariffs, we were concerned. So we sort of dialed back. We increased European and UK exposure. And at the moment, this year, we're seeing complete reversal. European and UK markets powering forward. US is pulling back. Yeah. So it's stood us in good stead at the moment in time.
Yeah, and I know some people might think that obviously there was a big bounce up into January, but that's now been wiped out. So we avoided all of that over that sort of 4-month period by doing that de-risking.
Yeah, I mean, ultimately, when Trump had his inauguration, the markets again rose higher, hit a new high, the S&P 500. Since then, it's pulled back sort of 6-7%. Yeah. Because it's just been sort of negative news, the trade, the tariffs, it's all come through, and it's not been a positive position at the moment. It's almost like when you take over a football team, you sort in the defence out first with the debt and all the concerns there, trying to get the house in order. And then hopefully as this tenure goes through, he'll be more on the front foot with cuts, and we'll see more of a positive vibe for the market. But at the moment, it's very much negative sentiment in the US.
But at the moment, obviously, we've not got a massive amount in the US, we're mostly Europe and UK.
2023, 2024, we did well by keeping up with the benchmarks because we are underweight US, underweight growth, and underweight tech. And that's for a reason, because we're obviously concerned with valuations and uncertainty. Now, rolling forward to 2025, that's looking like a good thing because we've got a much more broad equity spectrum. We haven't very underweight US, underweight growth and underweight tech, and that has helped make the portfolios really resilient. And at the moment, they're all in positive territory above cash for year to date, which is good considering the US has pulled back.
Yeah, and a lot of people will still be in the US and perhaps overweight there because they're a little bit too excited.
Well, it was looking like the only place to be. Yeah. Everyone was like, you've got to double up on US. It accounts for 70% almost of the world stock market. So it's almost like even if you have a market cap weight of 70%, you're material in the US. Whereas we were like, we don't want to be to that degree.
Just looking back on a different sector, so sort of the fixed interest, which for most clients will make up sort of 40 to 60% of their portfolios. How's that part done?
Yeah, it's been stable. We've had a couple of cuts come through, which has been good. But obviously, it hasn't been the material 4 or 5 cuts we were expecting. But you're getting a nice yield. Ultimately, you're getting 4 or 5% from gilts. You're getting 6% from corporate bonds, and high yield, you're getting 8%. Yeah. So even if things are quite flat in capital appreciation, that interest coming through makes a big difference, and it gives you that sort of nice level of stability within the models.
So with everything that's sort of happened, now that we've sort of rounded that off, what are the changes that you've made this time? I know that this is when we make our biggest number of changes normally is the start of the year. So what have you made and why?
Yeah, the first thing I'd say is in the FTSE 250 space. We, as you know, we negotiate quite hard to try and get the best cost price for our funds. So we've managed to replace a like-for-like FTSE 250 fund, and it's a 50% saving. So we've really nailed the offer there, which was pretty much a like-for-like change.
And that's something that we then can pass on to clients.
Yeah, ultimately.
It just reduces their charges.
It does, yeah. We took a little bit of profit from Europe and UK, but we're still positive on the regions. Yep. But let's trim a little bit. We've dialed in at the top end of the models in US smaller companies, because they've been hit quite bad. So we thought we've seen a bit of a leg down. If the economy is not as good in the US, we're going to see maybe more cuts, which might benefit smaller companies because they're more indebted. So we thought the top end will take a little bit,
Okay.
at a good price point there.
Yep. What about in the other sort of sectors?
Yeah, in the alternative space, probably our best position we've had over the last few years has been gold.
Yep.
Hit record highs of $3,000. So we trimmed a little bit there because it's been on such a good rally last year in this. We've broadened that out by having a commodity index fund, which is a broad basket of soft and hard commodities. And that's mainly there for diversification purposes and the fact that if inflation does spike up, you generally have a rally in commodities. So we should see price appreciation if inflation does, get high again.
Yeah, and obviously it's been creeping up over the last few months.
Yeah.
But we'll have to wait and see.
Well, that's it. I mean, ultimately, if inflation does creep up and rate cuts don't come through, we have got drivers in the portfolio like global index-linked bonds, infrastructure, and even the FTSE 100, because it's commodity. It's quite high proportion in commodities and banks, which should benefit from, even if inflation does increase, we've got drivers in the portfolio to benefit from that.
Any other sort of changes that you really want to talk about that we're making?
Yeah, sure. We've put a Chinese fund in that's mainly at the higher risk models. What we've done, we sort of reorganized the emerging market structure. We trimmed a little bit to put in US smaller companies. That reduced the Chinese equity content down, which we didn't really want to do. So we're putting in a Chinese equity fund. It kept that exposure because we've had a good rally from China. There's positive things there from the DeepSeek technological advances and the fact that the valuations are so much cheaper than the US. It's a deep discount. So we wanted to keep that China exposure to benefit from that, really.
Yeah. Anything else?
That's pretty much it. I mean, there hasn't been... Last year we did a raft of changes in January, but I think the way we positioned it in October was to be mindful of the uncertainties with Trump. So we'd already positioned the portfolio to be quite resilient. And 2025 year to date, that's proven the case. And I think the fact we did that, we didn't want to tweak too much. We're confident that the income and growth, the blend we've got, the underweight, US underweight growth, we didn't want a material change that at this moment in time.
Okay. So with those changes, obviously we don't have a crystal ball and don't know exactly what's going to happen, but what do you think the changes are going to hopefully do for sort of the foreseeable rest of the year?
Yeah, I mean, we're positive. We are positive. It's a concerning time in the US, but I don't think Trump will want the market to fall to a certain degree. It's obviously, I think it's down 8% at the moment. If it got to 15, 20, there's talk of like a Trump pot where he'll basically say, I don't want the market to fall further. I'm going to throw some measures out there to stimulate. Yeah. So I think from that side, you think he might step in with measures. European markets have been buoyant because since Trump's had the disagreements, obviously the Ukraine war and all that, he seems to be antagonizing, but it's meant European countries are looking at their defense spending, increasing their budget. Defense stocks have increased in value and European markets have been resilient. So we think that'll continue. We think there's positive aspects to European markets. So I think the change we made, we still see our portfolios as being resilient in all conditions. That's the...
Okay, so basically it's hopefully everything just continues sort of as it has been. And because we've taken quite a lot of that US side off the table, we shouldn't be as affected by their volatility.
That's it. It's the way we run it. We don't want to be over-reliant on one sector, one country, one economy, because there's so many dynamics at play at the moment. It's almost like you turn the news on every day and there's a different headline out there. So it can totally throw you. So the broad equity base has been really resilient, which is what we want.
Brilliant. Great. Well, thank you very much. Okay. And obviously we'll have another chat again in sort of 3 to 4 months' time when we do the next one of these. So, thank you.
That's okay. Thanks very much.